Welcome to CAM Radio, an Ahead of the Curve initiative by Cyril Amarchand Mangaldas, bringing you every Friday the latest in legal and policy. Stay tuned. Enjoy listening.
Welcome to Cyril Amarchand Mangaldas CAM Radio Clear Cut, Clarity with Class. In this episode, we are going to explore the Reserve Bank of India, an institution often seen as a guardian of India's financial stability. Can the RBI be the dark knight that India wants it to be? Picture this. It's 1935 and the RBI has been formed. And nearly 9 decades later, it's been at the forefront of shaping India's economic landscape, emerging as a symbol of economic sovereignty. Over the years, how has the RBI's role expanded and evolved? How does it stand at the intersection of financial policy, legal regulations, and economic aspirations? How has it been as an entity looked at for guidance, oversight, and even for throwing a lifeline in the times of crisis? How can the RBI craft regulations that strike a delicate balance between fostering innovation and ensuring consumer protection? And especially in an age where data is the new oil, how can the RBI safeguard sensitive information while still adapting to the ever evolving landscape of technology and cybersecurity? To explore this all, here's former Executive Director of the RBI Lily Vadera and CAMP's very own partner Anu Tiwari. Ma'am, I would like to begin with you and shooting with a straight opening question here. How do you see the RBI regulatory landscape in India today compared to 5 years ago?
I would like to mention that regulations are something which have to be in sync with the requirements of the Indian economy, and also in terms of global development, and therefore banking regulations keep evolving with the needs of the time. So if you see, earlier when banks started, you had nationalizations of banks so that you could cater to the agrarian needs for the farmers, for the small businesses. And then gradually, as the economy developed, then you wanted more competition to come in to provide better services, to leverage on technology. So you had the private sector banks, and then you had regulations to enable the foreign banks. So regulations keep changing with the needs. And then, with the whole financial inclusion agenda, then you came with the differentiated bank concept for, where the payment banks and the small finance banks came in. So regulation is something which is not static; it keeps changing with the need of the hour. Now, if coming to your question in terms of on the regulatory landscape in India, how I saw it 5 years ago and today. So in terms of this, say earlier, we had regulations which were entity specific. So you had regulations for banks, which were one set of regulations, and then came in the NBFC space where we wanted a lighter touch regulation. So there are different set of regulations because they were the entities that would provide the last mile connectivity. So the need for giving them more flexibility was felt. And so there was a separate set of regulations. And then you had the cooperative banks where there was a dual control. So it was not only RBI that was regulating them. And then with the change in the BR Act where RBI was given more powers, and then we saw the NBFCs growing, and then this whole concept of interconnectedness between banks, NBFCs, and the cooperative sector. So it was felt that a more holistic approach. So today, what you see is a more holistic approach to regulation, which looks not only at an entity-based regulation, but also an activity-based regulation. So that's the change that we see now. So you have guidelines like, say, for example, securitization. You have a common set of guidelines that are applicable to all lenders. So it's now on the activity of securitization. So it's a match of entity and activity-based regulation. So that's the first thing that we see. The second was that while the NBFC sector had a light touch regulation, there were some NBFCs which grew quite large in size in terms of their asset size, and they were almost as big as some of the banks, smaller private sector banks. And therefore, the concern for the regulator was that anybody that's grown too big may pose a systemic risk and pose a risk for financial stability, the banking sector stability, and so you came out with the scale-based regulations for that sector. So, which meant that if you were larger in size, you would be put to more stringent regulations compared to the ones which were not so large. So that was the next approach that we saw, that we see today compared to 5 years back. And then, after the COVID, that whole thrust on digital or digitizing banking service got a great fillip during COVID times. And so, it was felt that you needed to have some set of guidelines because there was a regulatory arbitrage between entities that were not regulated and those which were regulated, and a level playing field would be good. And so you came with the whole concept of the digital lending guidelines, which were focusing also on the customer protection point of view. So that was another development that happened largely after COVID. And then, because of this whole interplay of FinTechs and, growing, leveraging on technology to provide better services and FinTechs offering such solutions, then the regulator even now started thinking of a regulatory sandbox where you could, test some of these new innovations in a tested environment so that they don't become too disruptive. And the whole supervisory framework also underwent a change in recent times compared to how it was earlier. There again, the thrust was on the assurance functions of banks, which includes risk management, internal controls, and of course their internal audit. So this is some of the changes which I would like to broadly put in, in terms of what I saw earlier and what we see now.
That's sort of a great segue to sort of our next question. And we also want to understand from you that how do you see the RBI evolving or changing in the next 5 years, given the current themes and emerging trends?
As I just mentioned earlier, this whole thrust on digitizing the banking sector, leveraging on technology, I think that's going to be the way forward, so that more efficient banking services are provided in a more cost-effective manner. So I think if you see the payment space, that has really rapidly grown, and if you look at our India stack, that's one of the best in the world. Remittances and payments in a digital form have really, really ballooned over the years. So I feel that this trend will continue in terms of more and more digital banking services, whether it's payments or remittances. I think a big thrust will come to see how cross-border payments can be made quicker and cheaper and more cost-effective with the use of technology or with collaboration with the FinTechs. I think that's one area that I would see going forward. And apart from the space of payment, I think even in the credit side there is a credit gap, and therefore use of technology to provide cheaper and faster credit would be perhaps another focus area as far as the regulations are concerned. So I think that would be the whole concept of digital banking services would get further fillip and regulations around that. And as we get more and more into digital banking services, I think the new risks that come out in terms of cybersecurity, frauds, etc. I think those will also will have to be addressed. While there are regulations which the Reserve Bank has already come out in terms of addressing cybersecurity risks and advising banks, non-banks to step up their IT robustness of their IT system. So I think that is something which will continue to get a thrust from regulation because it's an evolving area. And then now that the functions of banks are becoming more complex and they're going to leverage technology, they'll have lots of data, and therefore I think there's going to be a lot of outsourcing to make their services more cost effective. It's not possible to do everything within the bank. So I think outsourcing is going to get a big fillip. And so while there are outsourcing guidelines by the RBI, but I think a lot more focus will go in terms of, monitoring and ensuring the data privacy, and there's no misuse of data, no leakages of data. So I think that's one area where regulation and supervision would be focusing, because that's one risk which is coming as a big operational risk, which will be faced by banks and therefore needs a close watch. And of course, customer protection will always be there. And as uh, if you see the recent guidelines on penal charges, which were basically to see that the customers don't get charged exorbitantly by lenders. And so I think a lot more regulations around customer protection, conduct regulations is what I see going forward. And governance is there. I mean, there are guidelines for banks, but I think in the NBFC space and also for the cooperative sector, we will see a lot more on the governance side, which is, I think, critical for the stability of the financial system. And I think this climate change is another area where I think some guidelines, or at least some requirement for banks to see how they will manage the transition risk from a fuel to a non-fuel or a green fuel based transition. So they would need to see how they would do manage that transition risk. But at the same time, one has to balance that we are a developing economy, and we obviously cannot ignore some of the fossil fuel based industry also, which is there. But how to green that sector would be another area that perhaps banks would focus attention. And after the data protection bill, I think there will be definitely some regulations around that to see how the responsibilities of banks and entities would have in terms of the responsibility that data fiduciary. I think those are broadly some of the points that I thought I'd cover.
Okay. Anu, would you want to add anything to that, to what sort of ma'am said on these 2 points?
Thank you, Shrija. Very comprehensive. I'm aligned with ma'am. So if one were to take a 5-year view, one sees basis trends, a lot more public process with central bank in particular. We already are seeing penalties being put out in public domain. Every application process now has a list which the regulator puts out. Something ma'am touched upon is no definitive rulemaking, increasingly on conduct and product side. I mean, M&A rulemaking has been fairly clear, hasn't changed in the NBFC banking payments world. But when it comes to business models, be it scale-based NBFC, be it payment aggregator, be it tokenization, be it digital lending, you doesn't know if the first circular is the last. A string of circulars have come out, so dynamic. Also, fairly consultative process with regulators, because new business models are coming. So rulemaking now is no longer, it was never knee-jerk, but now it's taking a lot more of the industry's views in the process. I think specifically on the M&A side, we already are seeing a lot more focus on the ultimate beneficial ownership. Regulatory deals were always tricky, but becoming more so. The focus has been on buyer's credentials, on source of funds, FATF. We saw NBFCs go through an FATF rule change. So may take longer to get important deals through the regulator. More supervision, as my ma'am said, we've seen a wave of supervision. And sectorally, data laws, NBFC, KYC, and then lastly, one area where rulemaking hasn't happened, but supposedly is on the anvil, is the tech fin, big tech related rulemaking, because now the world of finance is at times more in the tech than the finance side. So clearly the landscape will be dynamic.
Thanks for that, Anu, and such a meaningful conversation thus far. And it's time for shifting gears, Anu and ma'am. Let's talk about the 2014-2020 phase, which really involved the bank NPA and the NBFC crisis, which led to safe and more retail-oriented banking, Parabanking innovations and investments have been muted. Is mainstream BFSI sector missing new technology-led service delivery models and innovations, ceding space to fintechs or tech fins, and has time really come for Indian banks to be more experimental?
So, there was a phase where, the banks were saddled with high NPAs, and therefore, since the recoveries were not happening, to recycle and provide further lending was getting impacted. And so it was not only on the bank side that they were saddled with NPAs, but it was more of a twin balance sheet problem. So it was not only the banks because of their NPAs, but even on the corporate side, uh, you know, even their balance sheets or the bottom lines were getting impacted. So there wasn't any appetite then, even from the corporates to take borrow more because the economy was also slowing down. And at that phase, the demand for credit was also not there. And I think since the banks had already burned their fingers with exposures to certain sectors, which landed them with huge NPAs, so there was that little risk aversion. Uh, but I don't think that's there anymore because uh, we have actually come a long way from that NPA crisis with all that asset quality review and the intensive regulations and supervision that the RBI came up with. And so therefore, if you see the RBI publications on trends and progress or the financial stability report that comes out by RBI, uh, in fact, today, if you see the NPAs, the health of the banking sector is actually excellent. The NPAs are at an all-time low. They are adequately capitalized, and even now the credit growth has really picked up. So I think that's something of the past that we are talking. If you look at post-COVID, see, COVID was again for different reasons beyond anybody's control was a different scenario altogether. But if I even keep the COVID scenario out, but now in 21, 22, and now 23, we are seeing good credit growth happening. So the banking sector looks well, and even the corporates, the investment levels are going up. So things are looking much better now than what it was in the past. Of course, there are uncertainties as far as the global scenarios are concerned, with prices happening in certain countries and the Ukraine war and things like that. So there are certain global uncertainties. But India has a huge domestic economy which can absorb. Your domestic population can absorb a lot. So therefore, in terms of growth, I still see India as one of the fastest growing economies, and so I wouldn't be now worried about what we saw earlier in terms of the NPA crisis. Uh, in terms of whether the fintechs are outpacing the banks, during COVID, yes, the fintechs did come out with a lot of solutions to help at the time when the COVID was there and banks were not fully functional in terms of people not being able to go to the banks. But I don't think there's anything like, the fintechs outpacing the banks and the banks becoming redundant. I don't think any of that is happening. It's more a collaborative approach between the banks and fintechs, which is now what we will see. And I think that's good because banks have all the experience, the expertise as far as banking is concerned, and the fintechs are, entities which have all the expertise on the technical know-how of things and how to come out with new kind of product designs which can provide services more efficiently and cost effectively. So
But
I
actually,
think
ma'am, if you
what
see,
we see is a collaborative approach between the two.
but ma'am, if you see, the problem with the sector has been there are no exits given to fintech players or banking as a service, the BaaS players by banks. Unlike the
Hmm.
Western market where banks also give exit, buy out emerging players. So there's not been much of a para banking foray by the traditional top tier banks in India in last 4 5 years.
So, Anu, if I get you, are you meaning in terms of, uh, you know, entities acquiring some banks, is what you're talking about?
New age players, ma'am. Any
So,
new age players?
see, if new age players want to get into banking, okay, the avenue is available in the sense that you have the on-tap licensing guidelines for universal banks, you have on-tap licensing for small finance banks. So, if entities any entity is keen to get into the banking sector or provide banking services, you have that opportunity to apply, provided you meet the eligibility criteria and you fulfill the due diligence test. So it's not that uh, and I don't think in any country licenses go by the dozen. It's you, after all, banks are people that are having access to uncollateralized deposits, and so depositor protection is very, very key. And therefore the whole rigor of anybody getting into banking space in terms of the due diligence, in terms of their eligibility, that is something that has to be done. And eligible people will definitely be there to get their license. So it's all about uh, you know the willingness on people who want to get seriously into banking. Then you have fulfilled those tests and apply. I don't see why you should not. But then you have to meet that whole rigor of selection.
Right, ma'am. And ma'am, do you feel in that context, the time has now come for a digital only banking license? And reason why this question is coming up very often is we
Hmm.
have 500 plus middle layer NBFCs, 1,000 crore asset size, which is more
Yeah,
than many banks. We have 16 upper layer NBFCs.
yeah.
There is too much segmentation, differentiation in the ecosystem. Why can't we have a
Yeah.
common lending and deposit taking license regime? And of course, with guardrails.
Okay, and that's good. Now, see, for a digital only bank, whether the time is ripe for a digital only bank. You see, the Niti Aayog did come out with a concept paper on a digital only bank, right? Now, if you see in India, even if you look at the financial inclusion index that RBI comes out, so even in the March 22, I remember the people that were financially included were only around 56.4 in terms of that index. So there is still a large section that is financially excluded. Now, if you look at the rural areas, you still don't have access to banking facilities. And therefore, this whole thrust on having physical presence, plus you leveraging on the BC model, or even looking at technology to reach out to the remote corners of the country. But and so if you look at the branch authorization framework, banks have been mandated that okay, a certain percentage needs to get in. You need to open branches in the unbanked areas or underbanked areas. So that mandate still continues. So if you look at the kind of in the our economic scenario and the need for banking, you can't say that I will have just one bank and everything moves on, with the help of technology to cover. That's good, but to completely do away with the physical presence of banking outlets, I don't think, given the kind of economic the economy is in right now, where a large section of the population is still living in rural areas, there are network issues, and so you do need physical presence of banks. And I would look at it from another way, that while banks would be present there physically, but they can of course definitely leverage on technology to be able to provide services more efficiently and faster. So it's as somebody was rightly mentioning, that you can have a digital bank within the bank. So you digitize your services. But to say that I will not have any more banking outlets and just stick on a digital bank may not be appropriate at this stage. And even if you look at other countries, I was just seeing, like in the Southeast Asia, they're all experimenting. They've given limited licenses for a digital only bank to say 5 banks or few banks like that, to see how they deliver. and therefore it's still more of an experiment happening. But if you ask me, our payment bank was a model which was like a digital bank where we didn't, it was more of access points, but they were basically geared for the payment or remittance business. But
Right, not lending, ma'am, was a big
yeah.
difference.
So, but if you want to do the full scale, banking product with lending and everything, then you do need, given our, the rural economy cannot be ignored in our context. So, I'm not very sure whether, but the Reserve Bank did come out with the digital banking units which banks could set up where the
Yes.
entire services were automated. So things have been going in that direction to give a fillip to automation so that services can reach faster and more efficiently to people. But if you look at the NBFC space, we did start with digital only NBFC licenses, which we allowed for NBFCs because they were newer entities, they were more, having the leveraging on technology. So we did grant, NBFCs to have digital only NBFCs or hybrid with digital and, manual ways of lending. So that is available for the NBFC sector, which has been there for some time now.
Thanks for that, ma'am. And we'll sort of soon get into the wrap up, and we should definitely touch upon the new act. Anu, with the new Digital Personal Data Protection Act and its impact on the BFSI sector, will we see conflict between sectoral data regulations and the new law, given RBI has for long been at the forefront of data protection regulations, be it banks, NBFCs, or payments?
So, Shrija, this will be the biggest disruption in the BFSI sector because increasingly all models of money are also models of data, right? Albeit RBI or SEBI or IIDA have for long been framing data rules from a client confidentiality and with consent share. But now the whole architecture of how the notification works, building in the purpose, you can no longer just say I will do what I feel like doing for R&D purposes. I'll share within group. Error testing type purposes. Now one has to be specific. That's a big change, behavioral change. There are a lot of rights now that the principals have been given, data principle, which has to be built into the notice process. I think the other big thing is today, no, I mean, not just banking, but asset management across the whole BFSI landscape. People don't have systems and controls to be able to honor the obligations that come from this new law. And the other thing is the higher of the two standards will prevail. So one will have to first do a gap assessment to see whether the standard prescribed by, say, RBI for a bank or NBFC is higher. In many cases, you may see that sharing of data even with consent is not possible. So, the whole idea of consent under the new law does not work. So building systems, one will have to hire new people just for this role. A fair bit of training exercise has to be undertaken. So definitely, and if you look at just the examples that are set out in the new act, they all are aiming at two sectors. One is BFSI, the illustrations in the new act, and the second is e-commerce. So clearly, the focus from an enforcement standpoint, as rules come out, we'll see how it evolves. But seems like the two sectors targeted. One is BFSI as a whole, and second is e-commerce and social media.
Thank you. Thank you for that. And thank you, Anu and ma'am, for this meaningful dispatch. And so, we bring Cam Radio's exploration of the vital role of regulators like the RBI to an end. And through it all, we have explored how the RBI seems to be trying to put its best foot forward in its relentless pursuit of regulatory harmony. This episode has explored why collaboration, adaptability, and forward thinking are important to navigate the complex and interconnected financial ecosystem. As we look to the future, the financial sector continues to evolve at an unprecedented pace. And so, Cam Radio hopes you are left with new insights, a deeper understanding of the challenges and opportunities ahead, and a renewed appreciation for the critical role that regulators and financial institutions play in shaping our financial future. Until we see you again, Goodbye and good luck. Thank you.
Thank you.
Thank you so much, ma'am.